10-year bond yield is below 4% right now. And we just heard two words, Rick, I'm not sure I would thought we would have ever heard together: government surplus.
Yep. No, and it's all interesting. I'll try to put it together in a chronological timeline. That'll give you some clues. First of all, that data came out at the top of the 2, okay? 2 o'clock Eastern, 198 billion surplus. However, on a full fiscal year, we're going to be spending 1.2 trillion on servicing the debt. Even though it's under $1 trillion now, the fiscal year isn't over. And with the data out, well, the market started breaking under 4% well before those headlines were out. That's important. So let's first look at the 2-year. 2 years on pace for another. It's been closing basically at a 3-year low for several days in a row. Because if you go back to SEP of 22, earlier than that chart, a little more to the left, you'll see there's more of a drop. So we're going to be comping for a while, 3 years on the 2-year. But the 10-year's the big news today. Well, look at the 6-hour chart. You can see that we've been sliding all day well before the headline about the surplus came out. And boom, the minute we slid under 4%, everything accelerated. Why? Look at a week to date. Tuesday, Wednesday, Thursday. Every day this week, we banged on 4%. Think Pac-Man here. Munch, munch, munch. We're eating the supported 4%. Government's closed. Investors are getting a bit nervous. Once you take that many bites out of 4%, maybe the slowdown's going to weaken the economy. Maybe the China tariff thing's going to go worse than the market thinks. And I think that's really the motivation here, which means it might not last long. And when was the last time we closed under 4%? Almost exactly 1 year ago.